Good evening. We're giving people just a few chances, a little bit of time to get in. We see people coming in. So thank you all for joining us tonight. Bear with us while we wait for a few more folks. I know there are several that have registered. So thank you for making time to be here today. While we're waiting for just a couple of other folks, I want to go through some housekeeping with you. First, my name is Kathy Frakes, and on behalf of Omega, I want to welcome all of you to our webinar on tax planning in the Biden era this evening. At the bottom of your screen, you should see a question and answer or a chat button, either of those. My colleague, Jared Jones, is also attending this evening and he'll be monitoring those. Feel free to ask questions as we go through because there's a lot of information here and it's probably better to ask it while we're on that topic. If I don't know the answer, I will be honest and let you know that I don't know the answer and we'll be happy to research it and get back to you. I am not an accountant. I am a certified financial planner as well as a certified financial transitionist. So your accountant, your tax preparer is going to be your best resource for a lot of this information and the details for your particular situation. But we want to give you some idea of what to expect and how we're preparing as we plan financially for your future. So with that, let's get started. Well, there it goes. So 2020 has been quite the year, and I thought it would be fun to start off with just a quick little question, a poll, to see if 2020 was a song, what would you name it? What would be the theme song? So please, you should see it on your screen as well. Go ahead and answer what you would label 2020. We've got a few answers coming in. We have several choices. We didn't start the fire. I put that in there on behalf of all my friends in California and the fires that were there. So we'll go ahead and end that polling session. And you can see that the primary answer was help. And that is definitely what we hope to do as your financial advisors is help you through this process. We can't help with the COVID crisis, but we can help you plan for some uncertainties. So before we get deep into the Biden tax proposal, we wanted to explore, I'm sorry, this isn't advancing. There we go. We wanted to explore some of the things that are impacting your tax planning for 2020. Volatility in the stock markets was definitely part of 2020, but it can allow for opportunities for us to take losses for tax purposes, opportunities to reposition the portfolio while also staying invested. So one of the things that I wanted to cover with you is it might seem unusual to you. On Monday, you may know that the S&P 500 and the Dow Jones Industrial Average both set new record highs. That's fabulous. And yet you may get a report from us that says that you have a loss, a taxable loss for the year. And you wonder, how can that be? Well, one of the things that we do is called tax loss harvesting. So tax loss harvesting is a way that we can keep you invested, possibly reposition your portfolio, and make sure that you don't have to pay any more taxes than necessary. So in this situation, this client's particular case, we were able to sell out of these mutual funds, put them into a lower cost ETF, exchange traded fund. We were able to keep them invested in a similar portfolio as far as asset allocation, small cap, international, emerging market, whatever it might be, take a taxable loss of almost over $34,000. And yet this very same account in the month that we took a taxable loss of $34,000 actually increased in value over $180,000. So the taxable losses are different from your asset value. So it's not super clear, but it is something that we do on your behalf, and that's why you may see that you have taxable losses and yet your assets are actually worth more. Capital gain distributions from mutual funds is another thing that impacts your 2020 tax returns. So at the end of each year, mutual funds, by law are required to distribute their capital gains for the year. Now you have the option to take the capital gains as an immediate payment, or you can reinvest in that fund. Either way, though, you have to pay taxes on them. So this is a big part of our end of year tax planning. We're in the throes of it today. My colleague Andrea and I were poring over spreadsheets working on this today, where we go out, we reach out to the tax centers for each of the mutual funds and pull what they estimate their capital gains distributions will be before the end of the year. And then we calculate for each of our clients how that might impact their particular tax situation. So we wanted to make you aware how big of an impact that could be. These funds, according to the Caps Gain Valet, which is a service that we use, actually have capital gains distributions estimated to be higher than 30% of the net asset value of the assets. That's a big chunk of change, to put it plainly. We don't have anybody in these particular funds, but this is another set of funds that have capital gains distributions of higher than 20%. And you can see it could make a big difference in what your gains and taxable income may be. Capital gains distributions are always taxed at the long-term capital gains rate, regardless of how long you have held the mutual fund. So that's a bonus for you. That's a good thing in the tax law. One of the things that we talk about here at Omega is that we can't control the tax law, but we don't want there to be any surprises come April. So we try to make you aware of what the income will be, and that can help you make informed decisions. It may be that your income was lower this year because of COVID and related things that we'll talk about shortly. And we want to make sure that we know what income really is coming in, such as the capital gains distributions. As I said, we can't control tax regulations and legislation, but there is a lot of it. Some of the impacts that we have with regard to year-end tax planning, as far as came from the CARES Act. Some people may have been laid off. They may have filed for the unemployment. I want you to know that unemployment insurance payments, including the additional $600 per week from the federal government that was put into place by the CARES Act, they are taxable. So please know that when you get ready to calculate your income, you have to count that as part of your income. Required minimum distributions for those of you who are 70 and a half this year, all required minimum distributions were waived. You did not have to take them. Some people chose to take them anyway because they needed money for cash flow purposes to help with day-to-day expenses. If you took money from your IRA or from any other retirement account, it will be taxed at ordinary income tax rates. If you were one of those people that in January took your required minimum distribution, but then found out, like we did, that the distribution requirement had been waived for the year and decided to return it, if you returned 100%, there's no tax implication. Many people returned just the portion that they had received, but taxes had already been withheld. So the taxes that were withheld will be counted as estimated tax payments. So it's very important that you let your accountant or tax preparer know that you've paid in those withheld taxes from your required minimum distribution that were returned. And that's one of the things that we've been keeping track of throughout the year. For people that we've done this for, our clients, we know, and we will let your accountants know. One of the other impacts of the CARES Act were the recovery rebates. You may remember that you were eligible for up to $1,200 per person. So a married couple could get up to $2,400. and or the $500 for each child. These are not taxable income. This is actually a prepayment of a refundable tax credit on your 2020 tax liability. So the rebate was based on either the 2019 or the 2018 tax return, whichever was the most recently filed. When you file your taxes next spring for 2020, there's going to be a reconciliation that happens. It may be if your income in 2020 was lower than it was in 2019 or 2018, whichever was used to calculate this for you, you actually may get more money as part of the recovery rebate. If your income was higher in 2020, you do not have to pay back any of the rebate that you received. So if you got the full $1,200, that's yours. You don't have to return it. If you did not get the full $1,200, you may end up getting a little bit when you file your taxes. For our business owners, there are some other impacts from the CARES Act. You may get a possible refund of the payroll tax credit, a refundable payroll tax credit on the wages that you paid during the COVID crisis up to $10,000. There's a big calculation that happens. They have to look at your income quarter by quarter and whether it was higher than last year's same quarter. That's why you have an accountant and a good bookkeeper. If you need references or referrals, we're happy to do that. But just know that that may be a tax credit that you didn't have before the CARES Act. The Paycheck Protection Program, those loans have a lot of rules around them. As you know, you could only use it for certain expenses. While the loans themselves, a forgiven loan typically under tax law would be considered income. That is not the case. The Paycheck Protection Program, if a forgiven loan, that is not considered income under the CARES Act. However, right now, the rules are that any expenses paid by using the money from the Paycheck Protection loan cannot be deducted as business expenses. So even though the loan itself is not considered income, your overall income may be higher because these expenses now cannot be deducted. So please be aware of that as a business owner, that your income may be higher than you think because you can't take the same expenses that you normally would if you use the Paycheck Protection loan to pay for them. Another thing that the CARES Act provided is the net operating loss carry back. So for tax years in 2018, 2019, and 2020, if you had a net operating loss, you are allowed to carry that back up to 5 years. And that could benefit you because if you had high income years, you've already paid taxes on it. If you can carry the loss back to that year, 2018, or to 2013, 14, or 15, you may be able to recoup some of the taxes that you've already paid. It would require you to file an amended return, but you could get money back in that way. The final thing that I want to talk about is on business owners are the state and local tax deductions. This was actually from the Tax Cut and Jobs Act that was signed into law at the end of 2017. When I was putting these slides together, I thought, oh my goodness, I can't get over how many different pieces of legislation have been put into effect since 2017 till now. We've had a lot of changes. It's a lot to keep up with. But I want to let you know that just this month, I think it was November 3rd, the Department of the Treasury has come out with an announcement that says that they and the IRS are working together to try to make things more fair for the small businesses. So under the SALT deductions on the Tax Cuts and Jobs Act, individuals were limited to $10,000. That's all you could take. Even if you had paid more than that, you couldn't deduct any more than that on your itemized deductions. 10,000 was the cap. However, corporations were allowed to continue to expense it, and so they were getting the full benefit. So the Treasury has decided that that's not fair to small businesses, the S corporations and partnerships that pass through to the individual. So please be on the lookout for pending legislation. They are trying to come up with some regulations that would allow you to be able to take more of the deduction. We don't know what that's going to look like. Again, they just announced this and we haven't seen the regulations yet. So be on the lookout for that, and we will be too. Now, finally, what you really tuned in for probably, and that's a brief overview of the proposed Biden tax policy. Before we dive too deeply into it, I do want to state this is just proposed. You have to remember that the president does not set the legislation. That's our Congress, and we won't know really who's in charge of the Senate, whether it's Republicans or Democrats, until January when the runoff elections in Georgia happen. So chances of any of this happening right now are actually kind of slim, but we need to be aware of it. We want to make you aware of it so that if there are any planning opportunities and things that you want to consider, we can help you with that. So let's get started. The first thing that the Biden proposal suggests is that they raise the top individual's tax rate back to 39.6. You may recall it's been brought down to 37%, but the Biden proposal says let's put it back at 39.6, generally for those who make over $400,000. So $400,000 is kind of the magic fulcrum for the Biden plan. You'll see that a lot throughout these slides. That seems to be the breaking point. They feel like that's where the rich people are, and people below that, they don't want to have to raise taxes for them. One of the things that we heard a great deal about was the increase on the long-term cap gains and qualified dividend tax rate. So this is interesting because as I was researching this, I found that there was a lot of misinformation, and I had been told that he was doing away with the cap gains rate. Everything would be taxed at ordinary income tax rates. That's not quite true. The income tax rates will be ordinary income tax rates only for those who have income above $1 million, not 400,000, but $1 million. So that is very different than what we saw on a lot of the social media sites and what was kind of going around in some of the papers. So be aware that there is a difference, that everybody with income lower than that would still get to have what we think of as the cap gains rates as we have them now. One of the things that the Biden plan proposes is the elimination of the 1031 exchange for taxpayers with income over $400,000. If you deal a lot in real estate, this would impact you. Currently, under the law, you may know that you can sell a piece of real estate and buy a similar property within a certain time frame, and you don't have to pay capital gains taxes on that sale of the real estate. You just carry the basis over and you kind of defer it down the road. Mr. Biden says can't do that anymore if you have income over $400,000. We don't really know how that would work out, if you have to pay it right then or exactly the logistics, but that is his proposal. And lastly on this slide is the restoration of the PEAS limitations on itemized deduction, again, for taxpayers with income over $400,000. So the PEAS limitations were in place several years ago. They limit mortgage interest, state and local taxes, charitable contributions. So for wealthier taxpayers, you would not be able to deduct as much. And finally, the cap on the tax benefit of itemized deduction. He wants to cap it at 28% for taxpayers with rates higher than 28%. So what does that mean? So assume a taxpayer is in this new high bracket of 39.6%. He earns $10,000 cash, immediately contributes $10,000 cash to a charity. Normally, that income would come in, but then he deducts it and there's no tax. Under the Biden proposal, there would actually now be a tax because they're limited to only being able to deduct the 28%. You can only benefit 28%. So they would end up paying on that $10,000, they would pay $1,160 in tax on money that they no longer even have. So it really does impact how people will think about charity and may make different decisions because the tax impact won't be the same. And that is one of the things that we'd really like to take a deep dive on, because charitable giving is one of the ways that we're able to help minimize taxes in high income years. So this will have an impact. The Biden proposal phases out the new qualified business income deduction for taxpayers with, you can say it with me, income over $400,000. So I told you you'd see it a lot. He also proposes to expand the child dependent tax credits. It would go up to $8,000 per child, up to a maximum of $16,000 for the family. There's a temporary expansion of the child tax credit from $2,000 to $3,000, and they're providing a new $600 bonus credit for children under the age of 6. They also make the child tax credit fully refundable. They want to reestablish the first-time home buyers tax credit by providing $15,000 for first-time home buyers. And finally, they would like to try and figure out a way to equalize the tax benefit of retirement plans. So in our simplified example, we have a person who's contributing $10,000 to their 401k. They get a current tax benefit because it's pre-tax. They're in the current 37% bracket. So their benefit is $3,700. A low earner who contributes the same amount really only gets a tax benefit of $1,000 because they're only in the 10% bracket. So Mr. Biden's team has put together, they've looked at how much it would cost, and what they've decided is that it would be tax neutral if they were to establish a 26% credit. And so the proposed policy would be that if you contributed $10,000, each of you would be getting a tax benefit of $2,600. So that really benefits the lower earner more than it does the higher earner. Again, these are all proposals. We don't know that they're going to happen, but we want to make you aware of them. With regard to employment taxes, Mr. Biden's proposal is that they would institute an additional Social Security payroll tax of 12.4 on wage income over $400,000. So currently, Social Security tax is 12.4% up to the cap of $137,700 this year. Half of it's paid by employee withholdings, half of it's paid by the employer. Once you get over $137,700, that money is not subject to Social Security tax. Biden's proposal would say, fine, but once you get over $400,000, we're going to subject you to that tax again. So it kind of creates this donut hole, if you will, for the income levels between $137,700 and $400,000. He doesn't propose any changes to the Medicare taxes, though, just the Social Security. This is a big one for all of us who are in financial planning. Estate taxes. Mr. Biden proposes to eliminate the step, we call it a step up, in basis at death on the estate included assets. So the law is actually step to fair market value. So the truth is it could be up or down, but because most of the assets that are inherited have been held for a long time, it's usually a step up in basis. And that's a big benefit for people who are inheriting, for the beneficiaries. Now, we don't know if that means that there will be a capital gains tax due at death, or if the inheritor, the beneficiary, is going to somehow take over the cost basis of the asset from the decedent. One of the nice things, honestly, about having a step up in basis at death is that for many assets, we don't know the cost basis. If a client has had an asset for a long time, they may not know how much they paid for it at the beginning. So that has been a good thing as far as not having to worry about it. So this will be interesting to see logistically how it would work. Lastly, on the state taxes, the Biden proposal expands the estate and gift tax by restoring the rate and exemption to the 2009 levels. You may know that right now, for estate taxes, each person has an 11.5 roughly percent, $11.5 million exemption. That means if your estate is worth that much or less, there is no estate tax. Mr. Biden proposes that they bring it back down to the levels of 2009, which means that you would only be exempt for 3.5 million. So those of you who are in the $5 million to $10 million estates, if you would now be subject to estate taxes. So this is something that we're looking at carefully for each of our clients and figuring out ways that if this were to become policy, that we could help you plan your estate to minimize estate taxes. At the corporate level, the Biden proposal raises corporate income tax rates from 21% to 28%. They offer tax credits to small businesses for adopting workplace retirement savings and putting in mandatory enrollment. They would impose a 15% minimum corporate tax for reporting net income over $100 million and impose a minimum 21 GILTI rate on foreign profits. So the GILTI is supposed to reduce the incentive to shift corporate profits out of the United States, and this is doubling it from its current 10.5 level. Some of the possible opportunities and challenges around tax planning next year is that, again, we don't know who's going to be in charge of the Senate, what party is, and even when we do, there's no guarantee that people will vote along party lines. We don't know when or if any of these proposed policies will be effective. As you know, they can pass a law and make it retroactive. As I mentioned, that net operating loss carry back, right now, we know that 2020, under current laws, 2020 is the last year that that's available. But we don't know. Maybe next year they'll do something similar. We also don't know how long it will take for the economy to recover from the COVID crisis. And finally, we still don't know for certain all the policies around the Paycheck Protection Program. Please know that we're monitoring these and try to keep you informed as best we can when we get the information. So what do we do about all this? Well, as we've seen, the volatility of the markets, as well as provisions from the tax law changes, have an impact on your income level for 2020. Most of the time, tax preparers use your prior year, so in this case 2019, tax returns to calculate your estimated taxes. One of the things that we are really looking hard at, and why we're working so hard to figure out exactly how much you'll have in the capital gains distributions, is because we think 2020 may look vastly different than 2019 did for many of our clients. So instead of using last year, we would much rather have the CPA understand what your 2020 income looks like before you make that fourth quarter payment on January 15th. You may not have to make it. And why give the IRS any more money than necessary? So we'd like to talk about some of the things that you can do to help, and that is check your withholdings from your salaries and pensions. You can go to this website. The slides will be sent to you. Thank you for attending. So if we have your email address, we'll send you the slides. You can check your paycheck and see how you are with your income, whether you're having enough withheld when you consider the other income that you have. If you are making estimated tax payments, as I mentioned, please check in with your CPA tax preparer before making that fourth quarter payment on January 15th. You may not need to make it. For high earners, those of you over $400,000 may want to consider trying to pull income and deductions both into 2020, while your tax rates may be lower and the deductions are actually worth more, because remember, the itemized deductions are going to be capped at that 28%. Possibly, we don't know. So things to consider. If you're a business owner and you are just at that break even, maybe you had to close because of COVID and your expenses are different. If you're just at that break even level, you might want to consider pushing receivables out to 2021, maximizing any bonus depreciation that you have for capital assets that you've purchased, prepaying expenses in 2020, any way that you might be able to create a loss, because again, it can be carried back up to 5 years and maybe recoup some of the taxes that you've already paid. Finally, you might consider completing any large transactions such as the sale of real estate or a business if you're getting ready to retire from your business or sell your business before the end of the year. So that was a lot in a brief amount of time. Are there any questions that have come in, Jared?
I'm not seeing anything just yet. Give people a couple seconds if they have
we're
any.
giving them seconds. I wanna close with a poll because we talked about 2020. I'm curious what you think about 2021. Which would you choose if you had a choice for 2021? Oops, how do I do that? I want to launch a different poll. Well, let's try. Continue. Nope, that's it. Well, I don't know. You can just tell us. You can put it in the chat room. I apologize. I'm not sure why it's not launching. But you can put your choice in the chat room. So if there are no questions, again, we thank you so much for tuning in. This will be available on our website, on our blog, and we will send the slides out to you. It may not be until next week before we get it processed and out to you, but thank you for spending the evening with us. We hope you have a wonderful day. If we can be of any assistance in your end of year tax planning, please don't hesitate to reach out to us at Omega. Take care.